valuation is most certainly one of those things that if you're only doing it or thinking about it by the time the request or the need is there, you've missed a big opportunity. And we'll go through some of those pitfalls now, but this is really something where the more homework you do now, the more disciplined you are, the better the budgets you create, your forecasts, and the thinking that goes into it. Not only will you feel better about your valuation, but when it comes up to either a capital raise or an inbound from a strategic, or thinking how to value options that you wish to issue to employees as you think about expanding and taking on new talent, the more confident you are in that, the more you can defend your assumptions and your forecasts, the easier it is going to be for you to achieve the valuation that you believe your company is worth. We'll start with the extrinsic factors first, and there's two. You either look at a public company that is similar to yours, so a peer, and you look at where they're trading at. The second one is to look at what deals have been done recently in your space, and not just generally in healthcare, but really, this is one of those things, the more specific you can be, the better it will be. And that will give you another metric. With both of these, it's truly just multiples. And so if you don't have revenue today, then you look at, will you have revenue in 2021? And then you will have a 1 year forward multiple. Then move over to an intrinsic valuation. And this is probably the one that everyone's most familiar with or see a lot. And this one comes down to a DCF, or a discounted cash flow analysis. The input, should I say, is based on intrinsic assumptions that you are deriving as a company. It's intrinsic to you. Things like revenue growth and your 5-year projections. So again, always bring it down to cash flows. An LBO is a great model to run if you want to see how a private equity firm would value you. An LBO basically says, what is the most amount of money a private equity firm can pay for my business and still achieve a 17% IRR based on the inputs, the projections the management team has given them. But by and large, publicly traded multiples, recent deal analysis, who got acquired, who raised capital, your DCF, just those three should give you a pretty good range of where you feel your value could be at, and at least that initial just gut. Someone says your business is worth 30 million. You want to know if that's too high, too low, is it within a range? So I would start just with at least having those three and updating them regularly. A lot of the value of the underlying businesses are based on the brand, right? Which is a brand is intellectual property it's a piece of intellectual property. If somebody were to buy this IP from you, what revenue, or in the case of a DCF, cash flows would they be able to generate over the next 5 years if they had that IP? But I would encourage everyone, you should constantly be looking at the public markets, because ultimately the person that writes the check, or the strategic, if they have to answer to their committee, or they have to answer to their shareholders, they will have to justify why they paid so much more for your startup than what, and I just keep saying Teladoc because it's the first publicly traded one that comes to mind, than what Teladoc is currently trading. If you want to, jumping into it, I would say, if you want to be prudent, I would probably put around 12.5% as a good midpoint. And again, this is a place where you should run a sensitivity analysis and say, holding all the other variables constant, what is the different evaluation if I discount at 12.5%, 15%, 17.5%, or 20%? The very first thing I saw was, for a lot of the larger venture capital and private equity funds that I often speak to and have done deals with, they first pushed pause on all the deals that were live because they needed to recalibrate with their current portfolio companies who actually may need a capital infusion from the fund. So it was first, listen, before we go and make any new investments, let's make sure we're not letting one of our own companies fail. the difference between a capital raise and an M&A transaction, and this is critical for everyone, is knowing that you may be worth, your DCF may spit out a value of 40 million, right? And you say, this is worth 40 million because over the next 5 years, I'm generating this much in cash. And I, Mr. Investor, I'm saying to you, yeah, I know, but I'm giving you money today to achieve that valuation, right? And so I need to make sure that I'm seeing a return on my investment to you. And so that is where folks looking at it from a capital raise perspective versus an M&A perspective, you will always see valuations come in lower. Folks are doubling down, tripling down on diligence. Tripling down on diligence as it relates to forecasts, your assumptions, contracts that you may be getting. What COVID really has done is folks are really going to want to pay a lot of attention to your budgets and to your forecasts. And where you may have been given a free pass before because it's healthcare, it's tech, people are excited, you can sell some. You will need to defend those. When people give you money, they want to know how you're going to spend it. And so if we stick to capital raise, that's another area. If you want flawless diligence, if you go in and say we want 10 million, if you can account for every, I shouldn't say every cent, but like just as accurate as you can be and link that into your model, guys, that is, I've been on both sides of this table. That will get you so far because the person writing the check doesn't have to do your thinking for you. That's another important thing to remember quickly is just the people that you're pitching to, more often than not, they have a job like you have a job, or you run your company. They have a job and they need to get something through a committee and get approval. So it's never, if someone like really likes this or really doesn't like this, always think about how can you make the person that is pitching your company to their committee look like an absolute rock star. Well, I'll keep going on this. That's another great point is go look at the public companies in your peer group. And I encourage everyone to do that now. Just read and listen for a few things. One, look at what they call certain things. So you have a SaaS business, go look at a publicly traded SaaS company. Look at how they segment their revenue. What do they name it? The more you can use the same words, the same logic, you're not scary to an investor, right? It's something they know. It's harder to get money because people will only want to give you money once you've crossed that certain point. But the people that make a ton of money investing are the ones that invest in companies pre-FDA with believing that they either have the know-how or they can help them to get there. With that said, though, you really want to run your models on the assumption that FDA has been approved. As you guys will know, some of you have been through this, maybe you're just going through it, it will always take you longer than you think it's going to take. People that are writing checks know this to be true. You always spend more than you think you're going to spend, and it always takes you longer to do that next round. Tailor it to who you're speaking to. So let's say the amount's 10 million. And the more detail, it's going to be this much on FTEs, and it's going to be this much on product development spent over this amount of time, and you can, if you can give detail, you can truly ask for as much as you want. If your kid wanted to go to the grocery store to buy a few things, and like how much money do they need? Or you can give them $20 or $100. I don't know. What are they going to go buy? But, on the other ones, the one thing I'll say in overarching comment, it's always easier to raise money when you don't need it. There is nothing more powerful than going and meeting with a VC and they saying, how much cash flow do you have? And you say 18 months.